Hi there, Scott Spiker here from More Realty in Vancouver, Washington. And in this next series of videos, we will be going to touch on finance as it relates to real estate. In this particular episode, we will go over some home buyer basics and options for new and first-time home buyers. So if you have any questions about the process, products, or procedure, stick around and we'll provide a few answers. Welcome to our series on real estate finance. Today I'm joined by Austin Irwin from Directors Mortgage, and we are at their offices in Lake Oswego, Oregon. Austin is a member of the Irwin team whose combined experience spans more than 4 decades. They pride themselves in providing excellent, personally tailored service to all clients, regardless of their budget or situation. Hey, Austin, thanks for being here. Appreciate it.
Yeah, of course. Thank you for having me.
Yeah. Austin, the first thing we're going to go over here in this series is some home buyer basics and first-time home buyer property decisions. And just to start it off, so how does the mortgage process work? And if you're looking at it from the standpoint of somebody who's been a long-term renter versus somebody who's been a home buyer in the past, what's the advantages and how does that work?
Yeah, great question, Scott, on that. Basically, how a mortgage works is, well, you're borrowing money from the bank to be able to purchase the home that you have your eyes set on. So as a first-time home buyer, when you're buying, there's a lot of different options for loan programs. There's no money down programs, low down. You can put as much money as you want. I mean, there's no limit on that. But that being said, that's a conversation that you're going to have with your lender, like myself. You're going to talk about down payment, loan programs, and options. Once we tailor the right program for you, that's when you have your pre-approval, and then you connect with an agent like yourself and you start house shopping. But basically, the mortgage is the purpose to be able to assume the home. The down payment's coming out of your pocket, or you're doing no down, so you're going to have that. And then once you close on the home, you'll be paying on that mortgage, a mortgage payment, every single month for a fixed term. It could be 30 years, 20 years, 15. That's another conversation for your lender. But that being said, it's a really big wheel on how it works, but it's pretty simplified for the most part. And every time you make that payment, that is equity going into your pocket. It's not going to your landlord. So that's a big advantage as well compared to renting.
And so how does that compare, say, with somebody that's renting like a 3-bedroom or 2-bedroom apartment, 2-bath, price-wise, consideration when you're looking at that versus a mortgage? I mean, could those folks ideally get a mortgage and get out of the rent situation and have home ownership?
Yeah, great question. I mean, as you know, rent's not getting any cheaper. And in the Portland Metro, rent's rising at about 7.8% year over year. So really quick and rapid growth there. When you look at mortgages, well, a mortgage is fixed for 30 years. The only item that can really move on you is the property taxes, and that's if a new bond or measure gets voted in, or your homeowner's insurance if you have a claim. Maybe that premium goes up. Personally, for me, owning a home for the last 6 years, my property taxes have only gone up $50. So I haven't really seen a big move, and during that time, my mortgage payment has stayed the same, which has been great. But when you rent, that landlord can raise that rent on you every single year if they choose to. And so that is not a fixed payment. Even if your landlord was polite enough and was nice enough never to raise your rent, and let's just say you're paying $2,500 for 30 years. Well, all that money is going to the landlord. Whereas if you would have bought a home and paid that same amount in a mortgage, well, you're paying down your principal. That's your mortgage payment. That's money in your pocket when you look to sell, like with an agent yourself. Also, you're getting appreciation. And appreciation is the value of the home increases over time. And home appreciation nationwide is on track to be 5% year over year until 2027. Don't tell me that's not a good return on your investment.
Right. Yeah, absolutely. And that's a minimum, right? It's been more than that for the last 5 years here in this area.
Oh, yeah.
Yeah. And then getting kind of to that with rates, it's like I looked earlier this week and I saw FHA at like about 5%. I think I saw a fixed 30 at 5.37 and a 15 at 4.25. Is that, in your mind, do you see that increasing? Is that going to stay on the increase, or will we see that level off in the near future? What do you think?
You know, it's tough to say. If we had a crystal ball, we'd probably be sipping a Mai Tai somewhere on a beach. But
exactly.
That being said, I do think there's room for interest rates to continue to rise. How long? My guess is at least for this summer. Big reason being inflation is red hot right now at 8.3%. And inflation is the arch enemy of mortgage rates. So higher inflation means higher the return an investor has to get on the interest rate they're providing a client.
Wow.
Now, the one thing that the Fed is doing, and that's the federal, is that they're raising the Fed's fund rate. And the Fed's fund rate should push inflation lower. Right now, the Fed's fund rate is at 0.5%. This month, they should raise it another 0.5%, putting us at 1 full percent. So we should see inflation start coming down.
Nice.
If that happens, mortgage rates will come down. Historically, though, when the Fed uses this tactic, it actually pushes the U.S. economy into recession. That might sound scary for a lot of buyers, but historically, interest rates do really well in a recession-like period. So this could be a perfect storm for clients where they buy now, get that home appreciation, again, nationwide of 5%, and then next year, once they have more equity in the property, they look at refinancing, lowering the rate. But for now, you're probably expecting interest rates to be in the mid-5s,
Right.
depending on the product and program that you're using.
Okay. And then as far as that process, I guess, how long does that take from maybe, say, initial contact with you to figuring out whether they're going to make it as far as being able to get a mortgage or not?
Well, it all depends on the client's motivation. If the client wants to get pre-approved right away, we can get a loan application, supporting documentation, and supporting documentation is going to be different for every client. If you're self-employed, like a realtor, you're going to be looking at 2 years tax returns, bank statements, basic information. If you're a W-2 employee, we're going to be looking at getting your last 2 years W-2s,
Right.
30-day pay stubs, 60-day bank statements, and if you have any retirement accounts.
Okay.
But for the most part, our W-2 clients, we're getting pre-approved in 24 hours.
Wow.
Self-employed, a little bit more tricky because you got to work around more numbers. So
Sure.
I like to tell clients when you're self-employed, 48 to about 72 hours. We try to hustle faster, but start to finish, the pre-approval process won't take clients that long, at least with our team. We have a full dedicated team to the client, and we make it painless, at least try to.
Nice. Okay. Good deal. And then first-time home buyer programs, especially in the state of Washington, what are there that's available to those folks, and especially people that are on a budget, they're looking for affordability? Are there any like no down or low down programs that way?
Yeah, great question. Now, when you're doing a no down program, budget, well, that's going to be a little bit tougher if you're looking for a lower payment, because remember, when you have no skin in the game and a down payment, the investor has to have a higher interest rate, have a better return on that investment because it's riskier. So there are no down programs. I think that they're fantastic because it gets your foot in the door.
Right.
But there's the Chinoa program. That's a 0% down loan. They provide you a 3.5% down payment. So now you only have to worry about closing costs. And we pencil what that will be for you.
Okay.
There's also an offshoot of the Chinoa program where they'll give you 5% down payment assistance. So 3.5% will go towards the down payment, and then 1.5% will help offset your closing costs, making your what we call cash to close, the money that you're going to bring to the closing table, lower.
Nice.
There's also the Washington Bond.
Right.
And the Washington Bond's a really good program for more savvy buyers that are looking in, Vancouver, Ridgefield, wherever it might be in Washington, to have a lower payment and have no money down. It's more attractive interest rate than the Chinoa program, but there's more limitations on the Washington Bond than there are on the Chinoa program. And that's all things that we cover with clients. But maybe you're looking outside the urban growth boundary in Washington. Well, there's a program called USDA. USDA is 0% down, but there's an income limit, and the income limit depends county to county. And there's also what we call debt to income limit. So it's very strict, and I would say 9 out of 10 clients that look to do USDA loan unfortunately don't meet the parameters. But we have the Washington Bond,
Right.
and we have Chinoa.
Right.
Now, if you're a veteran, I love this program. It's called VA loan. And the VA loan, if you're a veteran, allows you to put zero money down, and if you have any disability service related, your funding fee's waived. saving
nice.
you 3.33%
Wow.
on the loan. So that's a big dollar amount for clients. Also, at Directors, we waive our processing and underwriting fee, saving our clients $1,490 on a VA loan.
Wow, that's great. And then generally, I think you kind of touched on this a little bit, but in the process of doing a loan for somebody, what are the criteria that you guys primarily look at?
Yeah, good question. It's pretty boilerplate for the most part, but we have that loan consultation. I find out what the client's real estate goals are. From there, we get the loan application, supporting documentation, get them pre-approved.
Okay.
Then they're going to talk to a realtor like yourself.
Right.
Start that home buying journey. We're going to be there with them every step of the way. Once they get under contract and accepted offer, that's where we put the pedal to the metal.
Okay.
We get the purchase contract from you. We get the loan ready for what are called disclosures. Disclosures are basically just a very long legal document stating the ins and outs entering a mortgage. And you're also going to see your loan estimate, your estimated closing costs, payment, interest rate, all items. And we have a very in-depth conversation in that. From there, once you sign your loan disclosures, we have the intent to proceed, and you go into processing. There might be some items that expired, maybe a pay stub expired. We're going to collect those updated items that expired, and then we'll get you into underwriting.
Nice.
There's two parts of underwriting. You have conditional, and then you have final. So you're going to get your conditional approval first. Once that happens, we might have a condition like a letter of explanation for a credit inquiry. Get that done. Once we get those conditions, we go back in for final approval. Now, during all this fun process, you're also going to get an appraisal. An appraisal dictates the value of the home. Once that appraisal comes in, let's just say it's at value, we can also send what's called a closing disclosure. Once you sign the closing disclosure, it's going to show you the exact cash to close that you can anticipate for signing. You'll also have your final approval, and then loan docs will be sent. Then they'll see you and myself at the closing table smiling because that's the last step. They're going to sign those loan papers. And they want to do a couple wrist warm-ups because there's going to be a lot of paperwork that they sign.
Right.
But once that's done, we will attain the paperwork and then either close that day and fund or the next day depending on time.
Nice.
So we can anticipate about 30-day close, start to finish.
That's great. And then as far as that goes, is there a percentage or an idea that you can give people in general what closing costs will be? Like, is there an amount or like a percentage of the overall cost of the home people can expect?
Yeah, that's a good question because I usually anticipate 2.5% to 3%, depending on the loan program, of the sales price.
Right.
So that's always a ballpark. But we always send loan estimates for clients before they make an offer, so they can anticipate what that cash to close will be for down payment if they're bringing in a down payment and those closing costs.
Right. Right. Okay. Cool. And then it seems like, and I'd like to get your feeling on this too, people when they're choosing a lender, a lot of times they'll go to the internet, for example, and they go, oh, great interest rate, you know? And then they'll find out once they've locked in 30 days later after they made like an offer on a home that, oh, they didn't get the interest rate that they saw when they first saw the ad on the internet, you know, maybe because they're carrying too much debt or their credit rating wasn't as good as it needed to be to get that. And I've also seen service gaps with those folks where they might not always be available when people have questions like weekends or evenings. How is Directors different that way?
Yeah, great question. So we've been in the community for almost 25 years now. We're a local company in the greater Northwest. That being said, it also allows us to have depth in products like 0% down, low down, jumbo loans, whatever it is. But a lot of lenders, especially those advertisements online, will show a really exciting interest rate. They'll put the credit at 740 plus, 50% down payment, and also disclose that you're going to be paying for that interest rate or buying down. That means you're paying points. Points are percentage of the loan amount that you're going to be paying for that rate.
Right.
So that catches a lot of clients off guard because, especially first-time home buyers, they don't know the lingo of points, you know, and that lender's not going to explain that. They're just going to show it on paper and say this is your cash to close, where directors, we're having that frank conversation up front. This is where interest rates are at today. Yeah, that online lender might be a little bit lower, but you're paying points, or your cash to close is going to be more. So when it comes to online and local lender, you definitely want to get pre-approved with a local lender. You're going to have more street cred, especially as you can tell when you're out there making an offer with a local lender like Directors compared to an online lender like Quicken. You definitely get more response when they see a local lender.
Right.
And then when it comes to availability, well, sometimes when you're working with that online lender, they're only working 9 to 5 or 9 to 4 or East Coast time. So when you call, they might not pick up. Whereas if you have a local lender, you get not only their cell phone, their direct line, and you have their Teams party extension. So there's always going to be someone in communication with you, whether it's nights, weekends, because it's a team effort at the end of the day.
Nice. Sounds good. So brings me to our next question, which is mortgage insurance, PMI. What is that and when is it required?
Yeah, PMI is private mortgage insurance. Mm-hmm. It's not there to protect the buyer. It's actually there to protect the investor of the loan. So if the client were to default, foreclose, short sell, that lender is going to get reimbursed what their investment was. Mm-hmm. And private mortgage insurance is required whenever you put less than 20% down. Now, there's programs out there that will require no mortgage insurance with little money down, but your cash to close is going to be greater, or the interest rate's going to be higher.
Right.
So if you're doing a conventional loan, you're going to have mortgage insurance on that loan. However, once you have 20% equity in your home, you can remove mortgage insurance. Now, again, if we're going off appreciation nationwide of 5%, you could anticipate probably moving that mortgage insurance in about 3 years, because what's happening as your home appreciates is it's that compounding interest effect on what it appreciated last year and the year before.
Right.
On top of that, you're paying down your principal, your loan balance.
Right.
And investors will allow you to remove mortgage insurance on a conventional loan in 24 months if you have the equity in the home.
Nice.
And you don't have to refinance. That's the beauty. Now, FHA, Federal Housing Administration, well, that's a loan where you're going to carry mortgage insurance for the life of the loan, or until you refinance or sell.
Okay.
So that loan, you just can't drop off the mortgage insurance. You have to refinance. But like we talked about earlier, most likely we'll be in a lower interest rate environment next year. So if you're doing a FHA loan, you'll be able to refinance next year, and your lender, your loan advisor, should be helping you if you have lower credit at that time to get you where you need to be, so you can go to conventional and get a lower mortgage insurance premium, or remove that mortgage insurance completely.
Perfect. And then last question here in this first video is pre-approved or pre-qualified. What's the difference and which is better?
Yeah, pre-qual basically means you and I had a conversation, I'm taking your word for it, and after that conversation, I hand out a pre-qualification letter.
Okay.
Most likely I don't have a loan application. I didn't even get supporting documentation. So it's just a gentleman's handshake. Whereas the pre-approval, which I always go with the pre-approval because we want to make sure the client's dialed in. We want to make sure that when they get that accepted offer that we're going to be able to honor the commitment we're making them to close not only on time, but also be able to provide that loan.
Right.
Pre-approval goes over the loan application, supporting documentation, and you get a full underwrite. The underwriter looks at your file, calculates that income, and gives them that pre-approval stamp.
Perfect.
So that being said, that's the difference. And if you have a pre-qual letter, there's not too many listing agents that are going to take you very serious when you make that offer with a pre-qual. They're going to take you serious when you have that pre-approval letter, especially from a local lender.
Nice. Okay. Hey, Austin, thank you. That will conclude our first in this series, and we'll have you for the next couple. And folks, stick around for the next couple of episodes, and we'll go into this a little deeper. Thanks.
Awesome. Thank you.
Okay.